Just like to thank Nicola for having us, thank New Zealand Winegrowers, and thank you for attending. As she said, we've travelled from Adelaide in South Australia, which is where the team who deal with all technical issues to do with wine and other taxation of alcohol is based. We're in a team of about 5 people who do general guidance, rulings, product classification issues for wine tax, but also deal with other alcohol issues. I'd just like to say at the beginning, we're not professional presenters, so if you can deal with a few ums and ahs, hopefully at least you'll get the information that you need. And the other thing that I like to point out is we didn't write the legislation, we're just charged with enforcing it. So all complaints go elsewhere. We hope that the session today will be useful for you. We just go through a bit of an overview of the scheme in its entirety. Some bits you probably already know, and we'll focus just on those things that have changed, focus in a bit more detail on those things. So I'll hand over to Naomi to start the session. We just sort of tag team a little bit so you don't get bored with one voice.
Thanks, Sally. So I thought it's always good to start these sessions with a bit of background about the wine equalisation tax generally and how that came into being. Some people are interested to sort of know a bit about the history and how we ended up where we are today. So I'll keep it very brief. The wine equalisation tax in Australia was introduced on the 1st of July 2000, and it was introduced at the same time as GST. And it replaced the sales tax regime that existed in Australia at the time. So the sales tax on wine in Australia was at the rate of 42%. When we often get questions around why is it called the wine equalisation tax as opposed to just the wine tax. When GST was introduced, GST is, and still is in Australia, 10% of the value of the goods. So the wine equalisation tax was introduced at the rate of 29% on the value of wine. So that's applied first to the price of wine, and then the 10% GST goes on top. So basically that works out to around about 42%. So the wine equalisation tax combined with the GST was introduced to ensure that the price of wine remains stable after sales tax was abolished. Since that time, a producer rebate has existed for producers of wine in some form or another. Started off as a cellar door rebate scheme. So wine equalisation tax was rebated or refunded for producers of wine that sold their wine through the cellar door at the retail level. Come in. So that was around about $42,000 worth of rebates. The producer rebate itself has changed a bit over time. In 2005, the producer rebate was obviously extended to producers of wine in New Zealand that export their wine to Australia, and on which wine equalisation tax is paid. So the extension of the producer rebate scheme in 2005 happened under the terms of the Closer Economic Relations Trade Agreement between Australia and New Zealand. The issue with the producer rebate is that for a number of years it existed in a form where rebates were paid largely on bulk and unbranded wine, sometimes in circumstances where wine equalisation tax was never paid. So over time, this led to distortions in the market, in Australia obviously. There was an oversupply of low-value bulk and unbranded wine, and it got to the point where the government said it just wasn't sustainable. So in August last year, changes were introduced to tighten the eligibility criteria for the producer rebate, and those changes apply equally to New Zealand producers that benefit under the scheme as well. So that's why we're here today. That's sort of a short version of the history. So the purpose of the presentation today is to explain the changes. As Sally said, we're going to give an overview of the scheme generally, but focus mostly on the changes because that's what you guys are here to hear about. So firstly, we'll talk about the cap reduction, so the reduction in the maximum amount of rebate that's claimable. Then talk about changes to the associated producer provisions. And then we'll focus on changes to the eligibility criteria because that's the big one for you guys. We'll also go over calculating and claiming producer rebates and the application and transitional provisions, so when do all of the changes come into effect. At the end, we also provide resources for you to use in the event that you have questions or you need further information. We would ask that you leave your questions to the end, if that's okay. We just find that the presentation flows a bit better if questions are left to the end, and sometimes your questions will be answered on the next slide anyway. Okay, so the cap reduction and the associated producer amendment. From the 1st of July 2018, the maximum amount of rebate that can be claimed for a financial year has been reduced from $500,000 in a year to $350,000. So up until the end of this financial year, the maximum rebate is still $500,000. This comes into effect for the following financial year. So that maximum amount of rebate that can be claimed applies to a single producer or a group of associated producers. And I'll go over the associated producer test in a minute. So that associated producer test now applies under the amendments at any time during the financial year, and that's from the 1st of October last year. So previously, under the law, producers could only be associated for a financial year on one day of the financial year, and that was at the end. So if producers were associated on that last day of the financial year, they were limited to claiming the maximum rebate for the year as a group. So now producers can be associated at any time throughout the year on any day. So regardless of whether they dissociate from one another, if they're associated at any time throughout the year, they'll be associated for the whole of the year and limited to claiming the maximum amount as a group. So that associated producer test applies to Australian and New Zealand entities. So if you're a New Zealand producer claiming under the International Wine Rebate Scheme and you meet the associated producer test and you're associated with an Australian producer, or vice versa, you can be associated with other entities in New Zealand. You can be an associated group for the purposes of claiming that maximum rebate amount. So it's just the timing of the application of that associated producer test that's changed under the amendments. The actual operation of the test and how it applies hasn't changed, that's remained the same. We do include a very brief overview of how the tests work as part of this presentation. It's new information for some people, and for others it's a bit of a refresher. So they are very complex tests. We could probably talk for an hour just on how those tests work, but that's obviously not the purpose of this presentation. So I will just go over them very briefly. The important thing to remember is if it sort of triggers anything in your mind that makes you think that you might meet these tests in relation to another entity, you can always seek further advice from us about that. So there are three main tests under which producers can be associated with one another, and as I said, limited to claiming that maximum amount for the year. This is the first test. The first test has two limbs. So the first limb is the connected with test or the control test, and that comes directly from our Income Tax Assessment Act. Under this test, producers will be associated if one controls the other. So the magic number to remember is 40%, so it's a 40% control test, and it's very much based on the structure of the entities. So for example, if these two producers are companies and producer 1 owns 40% of the shares in producer 2, then those producers will be associated and limited to claiming the maximum amount as a group. There's an asterisk next to that test because that control test, that 40% control test, is relevant for the branding and trademark requirements under the new eligibility criteria that we'll talk about a bit later on. So just put that to the back of your mind for now. The second limb of this test isn't based on entity structures. It's more around the facts of the relationship between the two producers. So where one producer is under an obligation or reasonable expectation to act in accordance with the directions or wishes of the other producer, they'll be associated for the purposes of claiming the maximum rebate amount. So that's a question of fact, and it relies on an examination of what's actually happening within that entity relationship. So that's the first test with the two separate limbs. The second one, again, it doesn't rely on company structures so much, so it's not that control test, but it's where two producers are under an obligation or reasonable expectation to act in accordance with the directions or wishes of the same third entity. So that entity sitting on the top. In that scenario, those two producers will be associated with one another and limited to claiming the maximum amount of rebate for the financial year. So again, that relies on an examination of what's actually happening within the relationships between those entities. That third entity doesn't necessarily need to be another producer, so I should just point that out. So that's the second test. And finally, we've got the third test. So just to quickly recap, we've got the first test with the two limbs, the connected with test and the under an obligation to act in accordance with test. The second test, where the two producers are under an obligation to act in accordance with the directions or wishes of the same third entity. And this is the third and final test, which is a bit of a round robin scenario. So if we start with producer one, again, not based on company structures, it's more about the relationships and what's actually happening within the businesses. So where producer one is under an obligation to act in accordance with the directions of producer three up the top. And then you've got producer three, if they're under an obligation to act in accordance with the directions or wishes of producer two, producer one and two will be associated in that situation. And before we move on, just to complicate things a little bit more, producer two and three and producer three and one in that scenario will be associated under the first test that I spoke about. So a combination of the application of this test and the first test means that all three producers in this situation will be associated and considered to be part of one group and limited to claiming that maximum rebate amount for the financial year. So that's associated producers out of the way.
Okay. So this is the eligibility criteria, and this is some of this, as we said at the beginning, will be different. Some of it will be the same, but we thought for the benefit of everyone, we'd just start at the beginning and work all the way through. On the seat, I think there was a flow chart. That flow chart is the things that we will work through today. That's just sort of something for you to take away, for you to look at and make sure that, I guess, when it's time to claim, that you're working through those things. That's relevant for each parcel of wine or each type of wine you might make. So just because you might meet it for one does not mean that you will meet that requirement for every wine that you make. And obviously it's fine to claim rebate on some wine and not on others. So that's the sort of 8 things that we will go through. Some of them were very, very quick because they're very self-explanatory. The things that we probably will focus on more are the source product test, the packaging and branding, because they're the relevant changes for New Zealand participants. So the first criteria, if we go through them in turn, first criteria, approved as a New Zealand participant. So those of you who are already claiming should already be approved participants. Need to be the producer of the wine. Wine needs to be produced in Australia and in New Zealand and exported to Australia. The source product test is the new one, the requirement to own at least 85% of the source product. Packaging, branding, and making sure that the WET's paid in Australia. So if all those criteria are met for each type of wine, rebate can be claimed by a New Zealand participant. So the first criteria, for those people maybe who are here who haven't claimed before and are looking to claim, the eligibility criteria for approval hasn't changed. You need to be the producer of rebatable wine in New Zealand, and the wine has already been or is likely to be exported to Australia. The only thing that's really changed or that affects this is the definition of producer, which we'll talk about in a sec. Throughout the presentation, I'll refer to probably grapes and wine because that's the majority of what probably is produced by people here. But it also applies to other types of products that are subject to the WET Act. So they are, as well as grape wine products, fruit and vegetable wine, cider and perry being pear cider, mead and sake. So all of those are subject to wine equalisation tax in Australia and would meet the definition of rebatable wine. Where people may already have registration as a New Zealand participant, but maybe due to the change in the definition of producer find themselves now ineligible, or for some other reason find themselves ineligible. There is a requirement to let the Commissioner in Australia know that you are no longer eligible for participant status for a New Zealand producer. And that needs to occur within 21 days of that circumstance in which you are now no longer eligible. By the same token, if the Commissioner becomes aware that an entity isn't eligible for approval as a New Zealand participant, he can cancel that registration at any time. So as I said, there's just been a little change in the wording of who is a producer. So the definition of producer under the WET Act is that you are either the manufacturer of the wine, so that one's easy, you make the wine yourself, or you supply another entity with the source product to manufacture the wine on your behalf. It's the wording there around source product that's changed. We will go through in a minute what classifies as source product, but just generally that is whole and unprocessed grapes or fruits and vegetables. So an entity who merely supplies bulk wine or parcels of bulk wine to another entity for blending purposes to do on their behalf would no longer be deemed to be the producer because they're not supplying source product. Finished wine is not a source product. So you need to be supplying, it's fine to have contract manufacture situations, but you need to be supplying that whole and unprocessed source product to still be deemed a producer of wine. We talk about manufacture, and not so much for New Zealand participants, but we have in the past had to help producers in Australia as to whether what they were doing actually was manufacture. Most of the time it's straightforward. It's making the wine out of that source product, but it's also combining parts or ingredients to form a commercially distinct product. So that would be blending of wine. Blending of wine is manufacture, but it is no longer eligible for the rebate. And as it says there, those sort of definitions are not exhaustive, and for some people they come to us for guidance, and we are there to provide guidance if entities aren't sure whether what they're undertaking actually is manufacture. So as I said, supplying source product. What is source product? So for grape wine, it's fresh grapes. And for grape wine product, it's fresh grapes. The Act doesn't specify fresh fruits or vegetables or fresh apples and pears for fruits and vegetable wine and cider and perry. However, when it does in the explanatory memorandum, talk about whole and unprocessed. So the ATO's view is that that is fresh product. So it's fresh fruits or vegetables for fruit and vegetable wine, and fresh apples and pears for cider and perry. For mead, it's unfermented honey, and sake, it's unfermented rice. So it's that real starting point, it's that source product. So the third limb, and this one I can race through because it's very simple. To be eligible for the rebate for a New Zealand participant, the wine must be produced in New Zealand. So the example there is that grapes can't be supplied to an Australian entity and the wine made over there and then brought back to New Zealand for bottling. Bottling's not considered to be production, so the actual production of the wine needs to take place in New Zealand. We do talk about a little bit later, there is one circumstance in which wine produced here can end up being bottled in Australia and still be eligible, but Naomi goes through that a little bit later. The next one, again, very simple. That wine needs to be exported to Australia. And this takes its ordinary meaning of export, which is the wine physically taken out of New Zealand with the intention that it be landed in Australia. So that one's fairly simple too. So that's no change to any of those criteria. The next one's the ownership of source product. Just as a refresher, that's what source product is. So as I said, it's the fresh, whole, unprocessed product from which the wine is made. We have been asked in the past whether de-stemming of grapes means that it would no longer be eligible. That's fine. It's just that it hasn't yet been crushed or fermented if it's honey or rice. So the test is that an entity is only entitled to the rebate where at least 85% of the finished volume of the wine originated from that source product that was wholly owned by the producer from immediately prior to crushing and until such time as the wine is placed in a container that meets the packaging and branding requirements. So they call it an 85% test. We sometimes refer to it as a 15% test. You need 85% of your own wine and then you can have 15% of something else in there. but it needs to be 85% of that finished volume needs to originate from source product that was owned by the producer who's seeking to claim the rebate. We've had lots of questions in Australia about what ownership is. How do I show ownership? What does it actually mean? The ATO's view is that it's good title to that source product. So I know in Australia, a lot of the grape supply contracts have remouper clauses in them. Those clauses tend to mean that title doesn't pass until perhaps a final payment for grapes is made. And where that final payment is after the crushing occurs, a producer could not meet the requirement of ownership. So what we've said is we understand there are other ways in which grape growers can protect themselves, which is not a clause around retention of title until that last payment's made. So, for instance, if the parties agree that title passes at the crusher, even though there might be 3 payments, still outstanding, that's fine. Where we can see that the intention of the parties is that title passes at the crusher, then that would be fine for our purposes. We've recommended in Australia that people who do have these sorts of contracts where they're buying grapes may want to get them examined potentially. As the ATO, we can't provide advice on what contracts should say or what they should look like. We can certainly give advice on an existing contract as to whether we think that would be okay, but we can't give advice as to what they should look like. Can we talk at questions at the end?
I just want to clarify,
Yeah.
we don't have remouper clauses in New Zealand anymore.
Okay.
So it has to be registered under the personal property security.
That's fine. And yeah, in Australia, we've been asked that question too, and that would be fine for our purposes most of the time under that scheme.
Yeah, we did get a lot of questions about that because our understanding is that even in Australia, those retention of title clauses aren't used as much. We have a feeling, just based on what we've seen with some of the contracts, that they've sort of been included, they've always been there. Whether they're effective retention of title clauses or not and can be enforced is another contract issue altogether. But we have a feeling that they've just been left in there in some of the older contracts. So yeah, there are issues around that for producer rebate eligibility under the new requirements. But we do know that, yeah, in Australia we've got the Personal Property Security Register, and I'm fairly sure that it works in much the same way here. Where, as Sally said, we can't provide advice on property or contract law or anything like that because we're from the tax office. But most of the time, where a security or an interest is registered on that register, yeah, it will be fine because it's sort of, even though we've done away with fixed and floating charges and things like that, where you've got something that sort of hovers over all of the assets and isn't grape specific, that should be fine and shouldn't impact ownership. Thank you.
So they're not enforceable in New Zealand.
Great, thank you for that. Now, evidence of source product ownership. For you guys, you don't actually need to supply any of these documents with your claim. They're things that you need to maintain should you ever be subject to an audit and they ask you to prove that you had ownership, but they're not documents that you need to supply at the time you make your claim. So examples of things that you might be able to evidence that you had that ownership were written grape supply contracts, weighbridge documents which show the tonnage, variety, the date they were delivered, tax invoices, and the production records of the wine. But as I said, they're not to be supplied at the time you make your claim. You just need to be mindful that if you are buying in product, it's not product that you grow yourself, you may need to keep some records. There's also a deeming rule around source product because when the draft legislation was put out, some of the fortifiers and other producers of wine said, we probably can't meet that 85% source product ownership requirement because, for instance, to make our fortified wine, we need to put in at least 15% spirit, and we don't own the grapes that make the spirit, so often we're not going to be able to meet that 85% requirement. So the government put in a deeming provision. So the way it works is that where any of these substances, so it's grape spirit, brandy, alcohol used in preparing vegetable extracts, ethyl alcohol, water, grape juice concentrate, where it makes up no more than 10% of the final volume, and any other substances where combined with like substances form no more than 1%, these can make up your 85%. So you don't need to own the grapes that made the grape spirit, or you don't need to own the grapes that made the grape concentrate. You can add those and they form part of your 85%. So they don't form part of that little extra 15%, they still form part of your 85%. I'll just mention where I talked about there's different products within the Act that classify as wet, so there's the cider, perry, all of those sorts of things. Each of those products has their own criteria that needs to be met for it to be subject to wet. And there are some limitations with some of the products. So for instance here, brandy is not allowable to be added to fruit or vegetable wine. So just because brandy is a deemed source product doesn't mean it can be added to fruit or vegetable wine. So it doesn't get you around those criteria. It's just that if it is allowable in a particular type of wine, it's a deemed source product. And also 2 of those deemed source products, the grape juice concentrate and the other substances, both have limitations. So 10%, no more than 10% can be added of grape juice concentrate, and then like substances where combined can be no more than 1%. If those percentages are exceeded, the entire amount can no longer be deemed source product. So as an example, if I was to add 13% of the final volume of my wine was grape juice concentrate, I can't say, well, 10% can be deemed, but 3% isn't. The entire 13% is no longer taken to be source product. We try and illustrate this with a little bit of an example. So this particular producer makes 1 litre bottles, and I always make the comment that that's because Naomi and I are really bad at maths, so a 1 litre bottle is a lot easier to work with. So this producer, of that litre, 820 mils of that wine came from source product that they owned prior to crushing. So that 820 mils is fine. They also put in 150 mils of purchased bulk wine. So obviously they can't meet the ownership requirement for that because that's wine that was made by someone else. Someone else owned that source product. They also add in 10 mils of Grenache and Shiraz juice of each of those, 8 mils of Mourvedre juice, and then 2 mils of preservative. So the issue for this producer is the portions of juice they put in are like substances. So where I said before, where substances are like substances, they have to be no more than 1% of the final product or volume of the wine. So they've added 28 mils in, which is actually 2.8% of the final volume. So none of that grape juice can be deemed source product. So it doesn't meet that 85% source product ownership requirement. The preservative is fine. It's not a like substance to those juices, and it only makes up 0.2%. So that's not a problem. The issue for this producer is that they used up their 15% of other substances right at the beginning because they put in 150 mils of purchased bulk wine. And because that juice is also no longer able to be deemed, only 82.2% of the final volume is actually from source products they own. So this producer for this particular wine would not be able to claim rebate on this wine. And as I said at the start, it doesn't mean that every wine that this particular person makes may not be eligible, but the makeup of this wine is such that there wouldn't be a rebate entitlement for this particular wine. Sorry,
Thank you. Okay, before we get to the new packaging and branding requirements, if you just refer back to this little flowchart, I'll just recap the eligibility criteria for the producer rebate that Sally's just spoken about. So to claim a rebate in relation to a particular parcel of wine, first off, you need to be an approved New Zealand participant, obviously. So if you can tick that box, then you move on to ask, am I the producer of the wine? So essentially, have you manufactured it yourself, or did you supply that source product, so the grapes, to another entity to have that wine made on your behalf, so contract manufacture? Then is the wine produced in New Zealand? If that's a yes. Has the wine been exported to Australia from New Zealand? If that's a yes. And then you go on to examine whether in relation to that wine that you're looking to claim the rebate for, you meet that 85% ownership of source product test. So did you own source product for at least 85% of the volume of the wine, including that deemed source product that Sally was speaking about. So then we move on to consider whether or not the wine that you're looking to claim a rebate for meets the new packaging and branding requirements. You might recall that right at the very beginning of the session, I mentioned that a lot of the issues around distortions in the market centred around the availability of the rebate in relation to bulk and unbranded wine. So the government put these new packaging and branding requirements into the producer rebate eligibility criteria to address that issue. So under the new law, the rebate can't be claimed on wine, bulk and unbranded wine. It can't be claimed on wine that doesn't meet these new packaging and branding requirements. We've had a lot of questions around these requirements, particularly the branding requirements and the trademark issues, and I'll speak about those in a moment. So in order to be able to claim the rebate for wine, it must be packaged in a container which does not exceed a capacity of 5 litres. So that's for all wine that's covered by the wine equalisation tax legislation, other than cider or perry. So that can be packaged in containers that don't have a capacity exceeding 51 litres. So that exception for cider or perry is in there because the government recognised that it's very common for cider to be sold on tap at the retail level, whereas great wine is normally sold in bottles or casks. So I will say at this point that at the ATO, we've had a number of people contact us to ask us if there's any room for movement around that particular requirement, whether they can get some kind of exemption. From that, the short answer is no. This is probably one of the more straightforward black and white aspects of the packaging and branding requirements. So the wine does need to be packaged in containers of that size, and if it's not, then it's not eligible for the rebate. Not only does the wine need to be packaged in containers that meet the size requirements, it also needs to be in a form that's suitable for retail sale. So the ATO interprets this to mean that it needs to be in a form that consumers would ordinarily expect to find the product sold at the retail level. So basically, it needs to include all of the required regulatory markings and also meet the branding requirements that I'll talk about in a second. So even though we talk about the fact that the rebate can't be claimed on bulk and unbranded wine, there is one circumstance, and it's only one, where, because of the operation of the legislation, a New Zealand producer might export wine to Australia in bulk and still be able to claim a producer rebate for it. However, that wine needs to be packaged and labelled in Australia, meeting all of the requirements that I'll talk about in a moment. And it needs to be packaged and labelled at the time of the assessable dealing in Australia on which the WET is paid. Even though the producer can export the wine to Australia in bulk and it can be imported in bulk, the producer needs to retain ownership of the wine during the packaging process. So that's the only scenario in which bulk wine can be sent from New Zealand to Australia and still be eligible for a producer rebate. So we've spoken about the packaging requirements. Now we move on to consider whether or not the wine that you're looking to claim a rebate for meets the new branding requirements. Most of the questions that we get around packaging and branding relate to branding because the legislation isn't overly prescriptive and the explanatory memorandum doesn't provide a whole lot of guidance. So we've tried to interpret the provisions in a way that's as practical and equitable and fair as possible. There are some grey areas in relation to this. We are more than happy to work with producers on an individual basis in relation to their branding arrangements to work things out and provide advice where we can. So, the container in which the wine is sold needs to meet the size requirement and it needs to be suitable for retail sale. To be suitable for retail sale, it must be branded with a trademark that is a trademark within the meaning of the Trademarks Act 2002. That's the New Zealand trademarks legislation, not the Australian. The trademark needs to identify or be readily associated with the producer. The trademark needs to be owned by the producer or an associated entity. So we've got or an associated entity in brackets. That refers back to that 40% control test that I spoke about right at the very beginning, but I'll go into a bit more detail about that. And the trademark needs to be one of the following. It needs to be a registered trademark, or an application to register the trademark has been lodged and is pending, or where it's an unregistered trademark, it needs to have been used by the producer since 2015. So I'll talk about each one of these criteria in a little bit more detail. So what does branded with a trademark actually mean? It means that the container that immediately holds the wine at the time of the dealing must be branded. So that refers to, for example, the label on a bottle of wine, or for cask wine, for example, it could be the carton. The government made it very clear that the rebate was no longer claimable in relation to clean skin wine. So it would be insufficient for a carton holding those clean skin wines to be branded with a trademark. As I mentioned, the trademark needs to be a trademark within the meaning of the trademarks legislation. It's got a fairly broad definition. It means a sign that's capable of being represented graphically and distinguishing the goods or services of one person from the goods or services of another. In addition, as I mentioned, the trademark needs to identify or be readily associated with the entity looking to claim the producer rebate as the producer of the wine. The ATO's interpreted this to mean that it needs to be identifiable as the producer's brand to the ordinary reasonable person. So somebody who comes into a bottle shop, for example, and picks up a bottle of wine, as opposed to someone that has an intimate knowledge of the wine industry and all of the different branding and marketing arrangements that might exist. This is one of those things that will be a question of fact in each case, and in some cases it'll be a lot easier to determine than in others, but as I mentioned, we're happy to work with people on an individual basis. The explanatory memorandum states that co-branding may meet the trademark requirements in certain circumstances. This is one of those grey areas. An example of a co-branding arrangement might be where the producer's trademark is on a bottle of wine, but that bottle of wine might also have a restaurant's trademark on it or a retail outlet's trademark on it. In some circumstances, those co-branding arrangements will be okay. In other circumstances, they won't be. A good rule of thumb, we find, is where the producer's brand is dominant on the packaging. So, for example, if it's the producer's trademark that's on the front label and the restaurant's trademark is sort of smaller and on the back, that would be okay. But where the situation was reversed, that wouldn't be. Okay, next, the producer or an associated entity has to actually own the trademark. The ATO's interpretation of ownership is that this is the right to use the trademark to the exclusion of all others, but it doesn't include use under licence or another permission, so whether that's an exclusive licence or otherwise, it has to actually be ownership. Whether or not a producer or an associated entity owns the trademark, again, is another one of those things that will be a question of fact. And again, in some cases, it'll be a lot easier to determine than in others. So, for example, where a producer is the registered owner of the trademark with the New Zealand Intellectual Property Office, they'll be the owner of that trademark, and that's one of those situations where it's easy to determine. Other indicators might include if the producer has the right to sell, licence or mortgage the trademark, or if legal action can be or has been taken for infringement of that trademark. As I mentioned, the producer or an associated entity can own that trademark, and the association between the producer and that other entity is determined under that 40% control test. So that other entity doesn't necessarily need to be another producer. That's just the mechanism by which that association is established. However, that trademark still needs to identify the producer. So the permitted types of trademark are registered trademarks with the Intellectual Property Office here in New Zealand, or trademarks in respect of which an application to register it have been lodged and the application is pending. So a decision hasn't been made on that application and the appeal process hasn't expired. In limited circumstances, unregistered trademarks can be used and still meet these trademark requirements. The government recognised that certain trademarks that can't be registered, that are, for example, geographical indicators, they generally can't be registered as trademarks, that some producers have been using these types of trademarks over time and have built up a reputation and a business around those trademarks. And it was felt that it would be unreasonable to compel these people to go and register new trademarks just so they could avail themselves of the producer rebate. So where unregistered trademarks have been used since the 1st of July 2015, until the time of the dealing on which WET is paid in Australia, those trademarks may still meet the trademark requirements. Again, it's another one of those things that's a question of fact. And again, in some cases, would be easier to establish than in others. However, use of an unregistered trademark during the required time might be evidenced by the provision of details of specific goods or services that have been sold using that unregistered trademark. Any advertising and marketing material, photos, signage, that kind of thing. The provision of historical context around why the trademark was chosen and how it's been used over time, and details of any confusion or dispute about use of the trademark. So again, this is another one of those things where when you make your producer rebate claim, you don't have to provide this evidence or this information if you use an unregistered trademark. But in the event that you're audited, for example, it would be useful for you to have those records and have that information and be able to produce that in the event that you need to. Sorry.
So the last criteria on your sheet, and probably one of the important ones, however, hasn't changed, is that WET needs to be paid in Australia. So for claimants under the New Zealand system, they have to wait until such time as the WET has been paid in Australia before the claim can be made. So it's either the producer themselves who may be the entity that pays the WET, or it may be another entity in Australia, a distributor or something like that. Once notification has been received by the producer that that WET has been paid, then they can claim the rebate. For instance, if WET is sold, and it's at the end of the financial year, so if wine is sold on the 30th of June and WET is paid, can be claimed in that financial year. But if it's in Australia but hasn't been sold or hasn't been WET paid, then it needs to wait until the year in which that occurs. It also has to be, or has to meet, the packaging and branding requirements at the time that WET is payable on that wine. And we are looking to potentially have the wholesaler statement changed as well, to put on there that sort of a declaration or a box to say when the WET was paid, that wine met the packaging and branding requirements of the law. So they're really on that flow chart, they are all the eligibility criteria. So where that's been met for any parcel of wine, a New Zealand producer would be entitled to claim the rebate. We just thought it might be prudent to put in a refresher on how that amount is calculated. The amount of producer rebate that a New Zealand participant can claim is 29% of the approved selling price. And the approved selling price is the price for which the wine is sold, excluding any expenses unrelated to the production of that wine in New Zealand. Those sort of expenses would vary depending on how people go about selling their wine, but they could include things like transportation, freight, insurance, agents' fees and any taxes in both countries. So they're things that are unrelated to the actual production of the wine. Conversion of foreign currency. So any of the components of the approved selling price must be converted into Australian currency. And so there's two methods under which that can be done. So the first method sort of has two limbs. It can either be the Reserve Bank of Australia rate on the earlier of the day you receive any payment for the wine or the invoice was issued. Or it can be an agreed rate between the parties. So it can be an agreed rate between you and the person that's purchased your wine as to what rate you use. Or at the end of the year, you can use the average yearly Reserve Bank of New Zealand rate. That rate is published on both the ATO website and on the Inland Revenue site soon after the end of the financial year. There needs to be consistent use. So whichever way you choose to do it, that's how you do it for the entire financial year. You can't, unfortunately, chop and change as to whichever one is most beneficial. It's one rate for the year, one way of calculating for the year. For the second one, you wouldn't need to really keep any records of what rate you've used other than to say, I've used that average yearly rate. For that first dot point there, you would probably need to keep some records as to how you've done your calculation for foreign currency. And just around claiming the rebate, for those of you who already do it, you'd know you can't claim before the end of the financial year. It's for wet paid during that financial year and claimable after the end of the year. There's not really much different to your claim form. You won't notice too many changes. The only difference will be there'll be a tick box where you need to say that you do meet the 85% ownership requirement and the packaging and branding requirements. There'll also be added to the declaration that you sign at the end saying that you have kept records pertaining to these things and that they're available for inspection should you be required to do so. So apart from that, the claim form's going to stay the same. We sort of touched on during the presentation the 85% source product ownership and the packaging and branding. Any evidence around that does not need to be supplied when you put your claim in. That hasn't changed. The things that you do need to supply are things that you would have supplied in the past. So things like sales invoices, New Zealand customs entries, Australian customs entries, evidence of the WET being paid, and that can be via tax invoices, wholesaler statements, things like that, and your calculation worksheet. So again, the government in Australia sort of said they didn't really want people to have substantially more record keeping requirements or, providing lots of more documents. So whatever you were providing in the past, if that's been acceptable to Robert, then nothing around that has changed. There you go.
She's smiling because she doesn't have to explain this bit. So the application and transitional arrangements, essentially, when do the new criteria come into effect? When do they start? When are they relevant from? There's no getting around the fact that the application and transitional provisions of the amended legislation are very complex. They're a bit confusing to read. We have attempted to make them as simple as possible, and I'll try and explain them to you in a way that's hopefully fairly easy to understand. We do appreciate, though, that different producers are impacted in different ways by these application and transitional arrangements. And again, it's another thing that we're happy to work with producers on if they've got questions and want to get in touch with us at any time about these. So, actually, I'll start with the easy stuff. So that reduction in the maximum rebate amount from $500,000 to $350,000, that comes into effect on the 1st of July this year. Then we spoke about the change to the timing of the application of the associated producer test. That's already in effect. That came into effect from the 1st of October last year. And then we get on to when the new eligibility criteria for claiming the rebate come into effect. So for producers in New Zealand, the two main ones really centre around that 85% ownership of source product requirement and the packaging and branding rules. So it's perhaps easiest to try and explain this in terms of there are 4 separate categories that wine might fall into for the purposes of when these provisions come into effect. So the first one we refer to as 2018 and later wine. So basically the 2018 vintage and onwards. So 2018 and later wine is wine where more than 50% of the grapes used to make the wine are crushed on or after the 1st of January this year. So for 2018 and later wine, the eligibility criteria come into effect from the 1st of January this year. So it's already in effect for that 2018 vintage onwards. So to be able to claim the rebate for that wine, you need to be able to meet that source product ownership test and the packaging and branding requirements from the beginning of this year. Now, the second category of wine is 2017 and earlier wine. So 2017 and earlier wine is wine where more than 50% of the grapes or other source product used to make the wine were crushed before the 1st of January this year. So that 1st of January date is really a line in the sand between 2018 vintage onwards, so the eligibility criteria starts from the 1st of January for that wine, and 2017 vintage and earlier. So where this, take your pens out and just cross out sold. The Act refers to accessible dealings. So we've had to work with that a little bit to work out what accessible dealing the Act is talking about in relation to New Zealand producers. So that should be imported into Australia before the 1st of July 2018. So where 2017 and earlier wine is imported into Australia before the 1st of July, there's no change to the rules for claiming the producer rebate. So claims are made under the old system. And the upshot of that is where you've got 2017 and earlier bulk and unbranded wine. If it's imported into Australia before the 1st of July, you'll still be able to claim the rebate for that wine. So that's the first two categories. Then we've got the third one, which is 2017 and earlier wine imported into Australia from the 1st of July this year. So that 2017 and earlier wine is wine where more than 50% of the grapes were crushed before the 1st of January. From the 1st of July this year, the new requirements, so the ownership of source product requirement and the packaging and branding requirements, apply to that wine as well. So from the 1st of July, those requirements apply across the board to all wine imported into Australia, regardless of the vintage of the wine or the date of production. However, in relation to 2017 and earlier wine that's imported from the 1st of July, there is a deeming provision in the transitional provisions. So I should emphasise that this deeming provision relates only to the 85% source product ownership rule. It's just relevant for that. If you don't meet these criteria in relation to 2017 and earlier wine, it doesn't mean that you can't claim a rebate for it. It just means that you actually have to meet the 85% ownership of source product requirement. So this deeming provision for 2017 and earlier wine imported into Australia after the 1st of July this year applies where the producer owned the wine from immediately before the 1st of January this year until the time of importation into Australia, so that refers to an accessible dealing. So the source product ownership test, so the producer will be deemed to meet that 85% source product ownership test without actually having to evidence it, will be met where the importation occurs before the 1st of July 2023, so that's the transitional period, and the wine is in a container at the time of the dealing, and the container clearly displays the vintage date, so where wine is vintage wine and can display a vintage date, or for non-vintage wine, where it's in the container before the 1st of July this year. So where all of those criteria are met, even though that 2017 and earlier wine imported into Australia after the 1st of July still needs to meet the packaging and branding requirements before a rebate can be claimed, the producer might be deemed to meet the 85% source product requirement, notwithstanding the fact that they might not actually meet it in fact. Finally, we're nearly at the end. The final category is fortified wine. So there's special transitional rules for fortified wine. Fortified wine takes its meaning from the Australia-New Zealand food standards. So it needs to contain at least 150 mils of ethyl alcohol per litre. So for fortified wine, where it is fortified wine and the producer owned that wine from immediately before the 1st of January this year and until the time of an assessable dealing, so that will usually be importation, the source product ownership test will be deemed to be met where the assessable dealing, so the importation, occurs before the 1st of July 2025. So fortified wine gets the benefit of an additional 2 years under the transitional arrangements. And on the 1st of January 2018, that fortified wine was in the process of being manufactured into fortified wine. So that basically refers to something like a multi-staged aging system for fortified wine, like a Solera system. Or the fortified wine was already in the container in which it was placed at the time of the assessable dealing. So that's the separate transitional arrangements for fortified wine, which also contains a sub-rule, just to make things a little bit more difficult. And this is in relation to stored wine that might be used to manufacture fortified wine. So really what this is referring to is wine that's stored in tanks and barrels and is essentially used in that topping up process, in that where wine that's in a multi-stage aging system is topped up from wine that's stored in tanks or barrels. So where the stored wine is to undergo further manufacture into fortified wine, a producer is deemed to have owned 100% of the source product used to make the stored wine. Where the fortified wine was manufactured using that stored wine before the 1st of January 2018, and the producer owned the stored wine immediately before the 1st of January 2018. So that brings us to the end. There's lots of resources available for you. Sally and I have our cards out the front with our direct contact details if you've got any questions that you'd like to ask specifically of us that you might not feel comfortable asking in an open forum. We've got our general WET guidance email address down the bottom. That's a permanent email address. Because of the way that our systems work, unfortunately, some of those queries don't come to us in the most timely of fashions. So we've also set up a specific email address for new measures, so wetnewmeasures@ato.gov.au. That's a temporary address, but will probably be in place for about 12 months. So if you've got any requests for advice that you'd like to send through to us in relation to any of this stuff, you can send those to the WET New Measures email address, and they come to us fairly quickly, and there should be a fairly quick turnaround time on those. And there's also a fair bit of information on our website, ato.gov.au, and also information and links to information on our website on Inland Revenue's website as well. So, after all of that, we've probably fried your brains, but have you got any questions for us? We're happy to answer any and everything wet or alcohol tax related.
Just one question on sales statements from prior this year's changes. If my sales statement comes back in and has included wine that wasn't put into bottle until, say, last year, but it's prior vintage wine stored in Australia, is it still eligible for the rebate?
I'm processing.
So
So
wine has been imported prior to the changes.
Yep.
Yes, under the
Some
old
of the
system.
wine is bottled and sold. It's come through on, say, last year's or the year before's producer statement.
Yeah.
Or sales statement. The rest of the wine sells in this period, sales period, but was actually imported the years before.
Yeah, that's fine.
Yeah.
Cool.
Yep.
So
right up
It would be
until
2017 and earlier wine imported
Yes.
before the 1st
Yes.
of July 2018.
So for that wine that is covered under the old system, those wholesaler statements are the old wholesaler statements. There's no requirements around notification regarding packaging and branding or anything like that. It's all under the old system.